You are listening to KeyStone's Stock Talk Show, episode 267. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. It's great to chat with you again this week. We have a busy show ahead of our new small cap 10x stock investment webinars that'll be live starting this week. I will kick off this week with a quick review of my appearance on Michael Campbell's MoneyTalks show this past weekend and a look at the relative valuation opportunity in small caps versus large caps. Brennan replies to a viewer question about KeyStone's views on using Sprott Trust. An example of those would be PHYS symbol or PSLV, or equivalent to hold physical gold as a portion of one's overall portfolio. In our Your Stock Our Take segment, Brett answers a viewer question on Poet Technologies, symbol PTK, on the TSX Venture, a designer and developer of optical interposers. We'll also find out what interposers are. The viewer asks as Poet has 20x potential. Finally, and on remote, Aaron answers a question on promising high-growth small-cap Kraken Robotics Inc., symbol PNG, on the TSX Venture, which just reported strong Q2 growth. The viewer asks our thoughts on the current valuations of this marine technology company, which provides complex subsea sensors, batteries, and robotics systems. Okay, let's get to the show. My co-host, Mr. Aaron Dunn, he's on assignment. The Killer Bees, Brett and Brennan, again this week, they're going to help rescue the show. So we're very excited. Are you guys excited? We're launching our all-new 10X webinars this week. Get your tickets. I always say first segment is already, and that may be already over by the time you're listening to this, but it's today. 90% sold out. We do have a room limit, and we're almost at that room limit. So get your tickets. If you can't get to the tickets on the 27th, 7 p.m. Pacific, there is a similar webinar on the 5th of September. That is 7 p.m. Eastern, which would be 4 o'clock Pacific. So I got a question for you guys. Did you know that about 1 year ago, basically to this date, KeyStone recommended the best performing stock on the entire Toronto Stock Exchange over that time, over this 52-week period? Did you guys know that? The stock is up 334% over that time. I will detail that company in my segment, so that's a teaser. But did you guys know that?
Do you want to know the only reason I did know it?
Well, I probably said it earlier.
Yeah, you had you told me last week, yes. And when you were asking, I was oblivious to that. But yeah, it just shows what the hard research and the process, the results that it will get.
Yeah, and we talked about it that time. There was the extreme valuation gap between small caps and large caps that exists still today. It's closed, narrowed. I'll talk about that a little bit. But I also talked about that kind of on Money Talks this weekend. It's always great to be on with Michael. He's a great host. We get tons of great feedback from that. We talk the markets, why we like small caps, just generally going back to the roots of where KeyStone started in that area, and updated some stocks and made a couple of recommendations. We can put the link probably to that segment below if they've posted it now. We can put that below on YouTube, and viewers can view that. About those webinars, well, first, we got a poll question that kind of dovetails into that. I'll talk about the webinars just quickly, but we got a poll question from this past week that kind of, plays into what we'll be talking about those live webinars.
Yeah, so the question for this week was, do you find it easier to sell a stock that's moved up 50% or down 50%? 75% of our viewers said it's easier to sell a stock that's moved up 50%, and then 25% said it's easier to sell a stock that has moved down 50%. And we got a comment as well, which I think really summarizes what a lot of people feel, and it states, when the stock drops, hope becomes a powerful drug. If I just wait to the next quarter, it will bounce back. That's, I think, a lot of similar sentiment across many people. Is that's normally the sentiment people have, is it is easier to sell when something's up versus down. I'll put a little graph of I forget what, Brennan, you might know because this is your segment coming up soon. Or go on.
What were you going to say?
I was just going to say, I'll put up the graph of what whatever it's called. I'll put up the name as well of the phenomenon of people finding it easier to sell.
Yeah.
Yeah. I mean, realistically, like, I'm not surprised that investors have an easier time taking profit on a name that's up. Like, just like from my own portfolio, it does sound somewhat counterintuitive, but for my own portfolio, one of the best decisions that I made over the past year was cutting losses on a specific investment that went sour and rotating it into a stock which has performed very well. So I mean, that's the opportunity cost there. It's like the one comment said, it's a hell of a drug to think, okay, well, hopefully this will come back, hopefully, and just the hope there. But again, if you're looking at, from a fundamental perspective, that's how we have to be looking at it, on a case by case basis. And again, like Ryan said, we've got a webinar on Tuesday, August 27th at 7 p.m. Pacific, and another on September 5th at 7 p.m. Eastern. And in that webinar, I go over some specific case examples on like when someone should take profit or not. As again, we tend to see investors take profit too early on good businesses that we want to hold long term to potentially become into those 10x names or 10x stocks, whereas they'll hold on to businesses for way too long when the investment thesis kind of has fallen apart. So I'm really excited to walk investors through that in the webinar. And essentially what you were talking about, Brett, there, I also go through some behavioral pitfalls and biases and give...
Like loss aversion, right?
Exactly. And that's...
Yeah.
Well, and this is where I was going to go with this, the disposition effect, which the loss aversion is in that. Again, I won't go too technical in the webinar. These are more things that we just want to kind of breeze through and give some real world examples. And then also, some best practices that investors can take away, when, building or analyzing whether they should continue to hold or if they are, coming under one of these biases. But again, the most excited that I am for is to walk through a couple of these case studies. And realistically, it can be applied to a stock that's went up or a stock that went down. Again, we kind of give a nice little framework of how to go through it.
Yeah, and we even give an example of and I talked about this on Campbell's show on the weekend, of a stock that's gone up 50%, like trading at 250, and then actually from a fundamental basis at $5 is cheaper and likely a better buy, than it was at 250, and just putting that framework into your head to be able to understand. You're not valuing it just on price. You're valuing it based on the valuations of the business, and getting that concept in your head, and then so if you own that stock at 250, you buy it, and then it goes to $5. You're not automatically selling a great company because it may be, again, look at it with fresh eyes. Does it have what is its relative value or its valuation then relative to where it was at $2? And if it's cheaper, the same, or even slightly more expensive, but continues to grow, has a better outlook ahead of it, you either are continuing to hold. There are times when we've even bought more at a higher price, right? Or if it's new money, a new client coming in, bought more at that point. And so just knowing when, and that's what we're talking about. If you do have one of these great stocks that gets into your portfolio, knowing how to continue to hold that company over time, if you want to really benefit from the 10x opportunity. It's not just the 30% you're looking for. You're looking for, we've had stocks, and we'll detail those that have not just done 10x, but there's 100x and 200x in a couple of the stocks that we recommended. So how can you continue to hold that? And then we just go really back to why we hammer on this profitability as a criteria. And we recommend small caps. It's one area where you can find mispriced securities. But why do we look at profitable small caps? Well, because you always hear there's this old idiom out there, and it's kind of when I say idiom, it's idiot. Really, it's stupid, but they say that, once the company becomes profitable, the biggest gains of the stock are already out of it, right? At that point, when it becomes, you want to get in before it's profitable. Well, anecdotally, I would say that's completely untrue. But if you look at the data doesn't lie. And this is why we're in the small cap and profitable small caps. Look back, it was a study done by Jenga Partners. We hammer on this study. We talk about it in the webinar. We've talked about it on the podcast before as well.
Yep.
But it was from 2012 to 2022. And globally, it looked like any stock that went up 10x or 1,000% or more. Well, 87% of those stocks that jumped 1,000% or more, 10x or more, over that 10-year period began as small caps, like small to micro cap companies. 80% of those were profitable at the start of their ascent, and 91% had a history of profitability. So the data is clear. You actually want profitability before you get into the stock, or when you get into the stock, it has to be a profitable business. Then you've got a far better chance of actually finding those 10x stocks that you are looking for. So we'll talk about that. We'll explain that in detail. We'll give real world examples, and we'll give you 5 to 6 stocks that you can start buying today. Some of them that have that potential, that 10x potential over the long term. All right, I think that ends the start of our show today, but we're going to get into my segments right now. So one theme we have been positioned to take advantage of over the past year has been the relative valuation gap between small and large cap stocks. This is up to the last week of September from Yardeni Research. Chart here shows the relative forward PE valuations currently for US mega caps, large cap, and small to mid cap stocks. So let's just take a quick look back to this fall, which was a good time to buy high quality, profitable small caps for a number of reasons. One was the relative valuations. In early November, the range we see is there's significant valuation gap between large caps here and the small caps represented by the S&P 600. The large caps there are represented by the S&P 500. Now, the S&P 500 large cap PE on a forward basis was 17.4 then, versus the small cap at 11.5, a greater than 50% premium, large caps versus small caps on average PE. Again, this is when there's some excellent buying opportunities in high quality earnings-based micro to mid cap stocks, but primarily get in the small cap space. Now, I often see analysts take a retrospective look at great buying opportunities in the past, which is frankly very simple. The key is, how did you react in that time? What recommendations did you make to your clients? What did you do in your portfolio? That is key, obviously, for the performance of your portfolio or your client's portfolio going forward. So basically, a year ago to the day, seeing the small cap valuation opportunity, we recommended Cipher Pharma at $389, bought for under 5 times earnings. 50% of its market cap was in cash. Today, it trades at around $16.90. It's the best performing stock on the entire Toronto Stock Exchange, up 334.44% over that time, and it's by quite a margin. We acted on this opportunity and literally picked the best performing stock over that 52-week period. So while the valuation gap has narrowed slightly, the forward PE on the large cap S&P 500 is 20.9 versus the small cap S&P 600 at 14.9. There is still a 40% premium. To put this in perspective, for the better part of the past 25 years, small caps, due to their higher growth profile, have traded with a premium PE multiple to their large cap brethren. The continued inversion of this ratio continues to create an opportunity if the multiple were to reverse in favor of small caps, as it held the first 20 years of the century. There is significant upside in small caps. Now, not all small caps are created equal. The universe we're using here for this comparison is profitable small caps versus profitable large caps, which aligns with our coverage universe. If you were to use a small cap measure that does not use profitability as a criterion, such as the Russell 2000 index, which holds a great deal of unprofitable small caps, they can look expensive relative to large caps at present. What this tells us is unprofitable small caps are expensive. Profitable small caps on average are less expensive. I would say that is in any time, but it's certainly exaggerated at present. So not all small cap companies, again, are created equal. In our webinars over the next couple of weeks, we will focus on why you want profitable small caps in your portfolio to help you find the next 10x stock and give you some current recommendations. And that'll end off this segment.
Yeah, no, it's always quite interesting to watch the different valuation sizes, but like Ryan was really stressing is we focus on profitable companies. When you're looking at those index level metrics, a lot of times you will have things mixed in which just we wouldn't touch in the first place. And that would even skew the data a bit more sometimes, or it closes the gap a bit. And that's something which you really need to just watch in general when you are looking at those index level metrics or comparisons, is what is actually in the index. So like Ryan was saying, the Russell 2000, frankly, just isn't a good index to compare us to, because we're not looking at unprofitable stocks in reality, especially since I don't know if they even require revenue for the Russell 2000 or not. I don't know if you know that.
No, I mean, there's a lot of junk in that index. So it's really hard to compare that to, the universe in terms of what we're looking at. We're looking at profitability. I mean, revenue is a criteria, but you don't have profitability without revenue for sure. But we need that profitability too as well. So comparing metrics, sometimes you got to be careful what you're comparing, obviously, when you compare those metrics. Okay, Brennan, you want to get on to your segment? I believe you're looking at a question on Sprott trusts, physical gold, or equivalent to hold physical gold as a portion of one's overall portfolio.
That is correct. So yeah, we got a question from a client who says, what is KeyStone's view of using Sprott Trust, example PHYS or PSLV, or equivalent to hold physical gold as a portion of one's overall portfolio? So both of these are closed-end mutual fund trusts. The first, Sprott Physical Gold Trust, PHYS on the TSX. There's also a US dollar version on the TSX, and I believe it also trades in the US as well. But the current price of the one on the TSX, just the PHYS in Canadian dollars, is $26.40, with about a $10.8 billion market cap and a management expense ratio of 0.41%. Now, the trust seeks to provide a secure, convenient, and exchange-traded investment alternative for investors interested in holding physical gold bullion without the inconvenience that is typical of direct investment in physical gold bullion. And the trust invests primarily in long-term holdings of unencumbered, fully allocated physical gold bullion, and it does not speculate with regard to short-term changes in gold prices, and the physical gold is held with the Canadian Mint or a custodian. And the other one here, Sprott Physical Silver Trust, or PSLV on the TSX, trading at $13.74 Canadian right now, with a $6.8 billion market cap and a management expense ratio of 0.6%. The Silver Trust is, essentially the same, but it invests primarily in long-term holdings of unencumbered, fully allocated physical silver bullion. And to answer Steve's question, generally, I do not think that either trust are a bad way to gain exposure to gold or silver, but a few things to note are, if you do plan to invest directly in gold or silver with these trusts, I would make sure that it is a smaller amount of your portfolio, perhaps, around 1 to 3%, as commodities are highly speculative and, in our opinion, can be quite volatile. We just don't know where they're going to go. Another point here is there are also some important concepts to understand, which make your returns different than what you may expect to receive if you held the physical commodity itself. So here's an example of a person on Reddit asking how they got screwed on his Sprott Gold Trust investment. So he says, I set aside $22,000 for my son's new car when he graduated college. When he got out, his mom put him in a pretty new truck, so we parked his $22,000 at Ameritrade, and he decided to buy PHYS on my recommendation. And just to make a quick comment here, first thing I would note is an issue with placing the full 22 grand in PHYS. This clearly goes against our strategy of diversification, and I would say is far too much exposure to a commodity in his son's portfolio. But anyways, that's just a side note. So to continue here, he says, we bought PHYS shares on October 14th, 2021. Looking at the chart of gold on Trading Economics, the gold price closed at $1,767 on October 11th, and it closed at $1,792 on October 18th. I could have sworn we bought his PHYS when gold was $1,787. So the 22,000 should be up 1.5%, but he's actually down about 0.14%. My God, that's $27 per ounce over a 2-year period. So what's happening here, essentially, he's asking. So let's look. Now, the trading price of the trust's units may become more volatile relative to the actual net asset value, or NAV, and could continue to be impacted by various factors which may be unrelated or disproportionate to the price of silver or gold, including things like market trends as well as the sentiment of investors toward gold or silver. And as such, you can see here directly from Sprott, I have up on the screen, the market price return of the gold trust, its underlying net asset value, or NAV, and the Bloomberg spot price return of gold all differ. And if you purchase trust units at a premium to the NAV, you may incur losses if the factors that have contributed to the increase in premium to the NAV were to disappear. The opposite would also be true if you bought at a discount. So keep in mind that the actual return of gold may be different from your investment in the trust, given both the premium or discount of the trust's market price compared to the NAV. And as you can see, since inception, the premium or discount to the net asset value has ranged from a premium of all the way up to 24% to a discount of 3.6%. So the market price may have been trading at a premium when this individual bought it, causing their actual return to be different from what the underlying commodity has actually done if that premium does disappear. And again, you can see over the past 10-year, 5-year, 3-year, 1-year, and 1-month period, the spot gold price return outperformed the actual return of the trust, with the one exception of the year-to-date period. On top of this, it's important to note that each trust has a management expense ratio, which will also eat into an investor's returns, as these are essentially the fees that you're paying. So while I do not think that it's a bad way to gain exposure to either gold or silver, and is certainly a more liquid way to gain exposure, given the ease of buying and selling in the open market, keep in mind the potential discount or premium that you will be paying over the net asset value and how it may impact your actual returns compared to the actual commodity. Today, if we look at PHYS in Canadian dollars, it's trading at a discount to the NAV of around 1%. And finally, I should also just add here, be aware of currency risk, as the net asset value of the trust is in US dollars. So if you are buying in Canadian dollars on the TSX, you will be exposed to currency risk as well. And yeah, that's my segment. Again, I don't think that, it's a bad place if you want exposure, but there's just some things that you have to be aware of, which I went over.
You did a good job of pointing out the risks there, which is great to see. And you pointed this out, one of the main things, I know it's not the main point you're making or the question comes from, but putting 20 plus thousand in one gold related asset, and we don't believe in mass diversification, but I mean, that is just, like we always say, 1 of 2 to 3 stocks in your portfolio. If you do that, even if you put all the research in, if you're just going to have 2 or 3, there's too much company specific, there's too much commodity specific risk here. And, not good practice to just be doing that in a portfolio. That kind of stuck out in that segment. I know it wasn't the point of the segment, but yeah, you see people doing that and you just question.
There's no way if my son had 22 grand, I would be telling him to place it all into.
And what was the return over that? Was this a year period or what? How long was it?
Sorry, for basically, I believe it was a year period. Yes, a year period.
And do you know the return they gained there? It was
I think he said it was actually, they were down 0.14%.
So you would have been better off in just a GIC.
Yeah,
this
is true.
Yeah.
This is true.
Yeah, and that's the other thing, not as well, not directly the point you're trying to make, is if you are looking at short-term things, don't be even, most of the time you don't even want to be looking at stocks or commodities or commodity ETFs. You want to just be looking at GICs. It's not even our specialty, and that's almost always what you want to do, because you're going to have those short-term, you're going to have the random walk down Wall Street movement, you're going to have the, I guess, random walk down Gold Street, and it could easily go down 30% a year. And if you were counting on that money, it's not there when you need it.
And this is coming from a group that loves growth, that loves taking risks, that loves, educated, obviously, risk to make long-term gains. But if it's a short-term, if you need that capital for a short-term goal or a short-term purchase that you have to make, you should not be investing in something like this. It's not that this is unto itself the most risky investment out there. It's just one investment. If it was one stock, even if it was, if you're putting that into a diversified S&P index fund, it's probably not good if you need it in 2 months or a year from now, if you need that capital.
No, and just a bit more further on the actual gold point is you'll see a lot of things quote online, very cherry-picked or time-sensitive data where they'll say gold outperformed the S&P 500, but it'll be this specific date range. And because of the volatile nature of gold, where some periods it's been up 100%, then it goes down by 50%, and it stays there for 5, 6, 10 years or whatever it happens to be. And then they'll quote, if you bought during this time period till now, it outperformed the S&P 500. But then it just conveniently cuts out if you bought out 1 year earlier, you would have performed drastically worse. So you really need to be careful when you're looking at gold, especially. I find it's quoted and graphs are shown where the data doesn't always reflect the reality, the volatile nature when you're especially looking at those total return graphs, as well as the quote indexes versus, like, if you want Sprott here, you're paying 0.4% management fee every year, which does, when you're looking at a relatively low returning asset over time, that actually does add up. And especially then further, you have the premium and or discount ratio, like Brennan was focusing on for the short term.
All right, that puts that one to bed. Let's get to Brett's segment on a viewer question about Poet Technologies Inc., symbol PTK on the TSX Venture.
Yeah, so we got a question. We've been doing those. Brennan did a couple of them, the 10X segments that we've really been getting people asking, 10X, 30X. This one was, is Poet Technologies, symbol PTK on the TSX, or Poet on the NASDAQ, does it have 20X potential? So we're going to the middle this time. A lowly 20X gain it's not as great as the 30X, but it's better than that 10X. But Poet Technologies is a designer and developer of optical interposers. The company's optical interposers is an optoelectronic solution that allows for the integration of electronic and photonic devices onto a single chip for usage in high-speed communication for data-intensive applications. So they like to quote AI applications, which everything which can even be tangentially related to AI is these days, but it's for data centers and other high-speed communications. Effectively, the goal of their products are to really scale down existing optical transceiver solutions at this time into a smaller design, allowing for cost savings. And if you don't know what an optical transceiver is, really, if you know what fiber optics are, that's light. It needs to be converted to an electrical signal for computers, and that's what these do. So the stock is currently trading at $318 on the NASDAQ. It's down 15% over the past year, but it has recovered significantly from its low of 80 cents late last year, causing a 6-month increase of 132%. So clearly a volatile stock, and that's really why I think we're getting a lot of interest in. This isn't the first comment I've seen on it, and I've seen a lot of buzz online about Poet Technologies in general. And when you have volatile returns, that's generally what I see anecdotally. So a quick look at the financials. There's frankly not much substance to it at this time. For Q2 2024, the company had no revenue, with low inconsistent revenue in prior quarters, but nothing substantial. And I believe it just relates to engineering services for prior revenue. But even then, it's still nothing material. The company does have a non-consolidated revenue in a joint venture, but at this time, that's completely unprofitable as well. Unsurprisingly, a significant cost is R&D expense at $2.6 million, which does include notable stock compensation about $500,000. SG&A came in at $4.1 million with stock compensation of $1.1 million. So like many tech companies, they're really leaning on that stock compensation. Total operating expenses came in at $6.8 million for the quarter and $11.9 million for the first 6 months of the year. The net loss for the quarter was $8 million or 14 cents a share, or $13.7 million and 27 cents per share for the 6 months. So moving to the company's balance sheet is comprised of $21.2 million in cash, no debt, but it has leases of $400,000, resulting in a net cash position of $20.8 million. Not bad, right? However, as I said, the company is just not producing any material revenue, so it can't produce cash flow. So you need to really look at where the cash is coming from. For the first 6 months, operating cash flow before working capital, or FFO, was a deficit of $8.1 million. So cash is from raising capital. You can just tell from that line before even looking at anything else. Notably, the company was really effectively out of cash runway at the end of Q1. They then proceeded to conduct private placements and at the market issuance to raise capital. The company at the end of Q2 now has 61.7 million shares outstanding, 11.8 million warrants, all in the money, and 9.5 million stock options as well, also all in the money. Meaning if they all are exercised, the diluted outstanding shares at the end of the quarter is 83 million. I will note only 2.6 million of those options are exercisable at this time, but they are well within the money. So if the price were to even stay at this level, they'd likely be exercised down the line. Through all this, the company had raised $29.5 million in the first 6 months of the year, more than its current existing cash balance. So they would have been negative cash balance if they didn't raise money effectively. They would have been bankrupt at this time. They would have been selling off and liquidating in some sense. If fully diluted, the company they'd actually get cash from their options and warrants, and they'd get another 40 million in that ballpark of additional cash. And that's likely what they are counting on, is just additional exercising of their warrants and options over time. Additionally, after the quarter's end, we have more raising of capital. The company raised another 10 million US through an issuance of 3.3 million in both shares and warrants. So further dilution. The summary of all this is the company needed cash, significantly diluting the company since the start of the year. For comparison, the non-diluted outstanding shares at the end of 2023 was only 41.3 million. So if we went to a fully diluted state, you're looking at literally double the shares over the last 6 months, because they really need to raise that cash. But bringing back to really the initial comment of, is this a 20x stock? To give an idea, that would put the company at a 4 billion market cap. With its current market share, it would be at 4 billion. But if we were to then go to the fully diluted market cap, it would be at 5.5 billion. And if you were seeing something 20x, those shares would be 100% exercised on. It would make no sense that they wouldn't. So 5.5 billion if you were to look at something like that. So just the sheer size of the market cap for something like that for a currently zero revenue company is already getting quite absurd. And even if we optimistically valued a company like this for a hardware company, a computer hardware company at 5 times sales, which is already optimistic. A lot of them are only 1-time sales. You'd be looking at needing $1 billion in revenue. And really, I just don't see that happening. That's just too massive a leap. Even if you're looking 5 or 10 years down the line, maybe 10 years, you can maybe make a case for something like that. And that'll be blue sky scenario, best case scenario. You're not doing better than that type of scenario. So I really want to stress on that. By no means do I believe that is going to happen. But even if you were to believe a scenario like this were to happen, where you are expecting a 20x return, because I've seen a few videos, which some of them were actually had received funding from Poet indirectly or directly, where they're stating, oh, it can go way up. I've seen sponsored reports that they're doing their target prices at 2 times the current stock price or 3 times the current stock price. That you need to have these massive runway up in sales over the very near term. And that's just, I don't see the pathway to that. It's a competitive marketplace. They would need to have mass commercial volumes, and that requires the customers to uptake it, which is a hard hurdle to scaling. You need to get big companies in, you need to appeal to them, and that's hard to see from zero revenue to happen that quick. Further, the production actually needs to be profitable at scale, because they can't keep issuing shares They would need money to do it, so it needs to be profitable. That's a massive, massive hurdle, and that's why we like profitable companies, because you don't need to worry about that hurdle. You can't just rely on raising capital forever, and that seems to be what many of these companies do. Not saying Poet will, but that is the trend of these companies, where they just look to raise capital forever and hope to have some sort of revenue someday. But if you were a shareholder today and they keep doing this for another 3, 4, 5 years, you're looking at your ownership of the company being a quarter of what it was, half of what it was, whatever it may be, because they continuously dilute over and over again. And then further, we always get these comments along the lines of that you need to risk to have some sort of high return. And that's just not true. Your job really as an investor is to look for that balance between risk and reward. You're looking at that trade-off. Just because you're taking a lot of risk doesn't mean you're getting a lot of reward, or a potential a lot of reward as well. And I will just further mention is the company is having most of its near-term projects through a joint venture of which it partially owns, but that adds a further risk as a Chinese joint venture, and as well a lot of their manufacturing is expected to be that for the near-term products, which furthers the risk as well, and as well it lowers the outstanding return, because obviously the joint venture, the other player in it, gets a portion of that revenue and portion of the resulting equity. So let's say a year from now they start to have revenue, they start to build a customer base, then it may be worthwhile. As yes, the price may have slightly increased to then, but that does not overcome the risk you have in the short term, in the near term, in the next 6 months, year, 2 years, which even if they do potentially get to that point where they do have revenue, they do have sales, it just is too much risk for what reward you're expected to get, because it already has quite a bit of that priced in at its current time. Like I said, it went up over 100% in the last 6 months. Are you really expecting that to happen again in another 6 months? You're expecting it to be effectively, like Ryan was saying in his previous segment, we had the best stock in the TSX, and that was about 300% over the past year. That's not going to happen to every single stock, and that's what people who are quoting that 10 to 20x are stating, is you're expecting that 100%, not just this last 6 months, but again and again and again. It's just unreasonable. So it may be worthwhile someday. Poet Technologies may be worthwhile someday, but we'd be waiting for revenue and profitability. And I would not count on its current fundamentals in any way to support its even current stock price, let alone 20x, as they are so far off of being appealing at this time.
Yeah, it's a good summary. And I think just even going through where they'd have to get to be at 20x stock, 5 times sales of $1 billion. I mean, it's just so much that has to go right for this company to get to that stage. And again, we've been harping on this the entire show. Where do you find, and we're talking, the question was on 20x, but where do you find even half that at 10x, which is tremendous growth over like a 5-10 year period? Where do you find that? It starts off with profitable smaller to micro cap companies. Like it's 9 out of 10 basically were in that category. You're fighting in the bucket that has 1 out of 10. If you're looking at Kraken, I would rather play in the area that has 9 out of 10. And that's where we start to analyze those companies where they've had proof of concept. And proof of concept includes people actually purchasing your product or service. And that's where that is where you can find these companies that have tremendous growth potential over the long term. They're already growing now. Buy them at reasonable prices, watch them grow into the future. Again, I will say that, but the data says that. The data says this is where you should look, and you should listen to the data. And if you keep investing in, the issue too is to find a stock that has 10x potential, you don't just buy one stock. You're going to buy, within a 25 stock portfolio, it may be 10 to 12 that have that potential or have that profile of a business that could potentially be. And you're going to hope to have 1 or 2 of those stocks. And even one can change your portfolio. But if 10 or 12 of those all start off as unprofitable, it's not only going to, unlikely to that stock, it's unlikely that any of those stocks are a 10x stock, but it's more likely that those stocks, go down 50% or go down to 0 if they're not profitable. If they never can prove out to be profitable, that stock will go to 0. And that's what the flip side is. You're trying to prevent the downside as well in these stocks is far higher if they've never achieved anything close to profitability.
Yeah, and that's really what I mean with that risk return trade off. Is you want that asymmetric risk, and that's what profitability and underlying fundamentals give you. Is you can still look for those blue sky potential companies, but you also want to mitigate the downside. And companies with no revenue don't really have a bottom floor to their downside. When that happens to a fundamentally strong company, they end up getting bought out. And that's what happens again with like the cash rich companies we cover. They have such strong fundamentals, even if the stock market isn't rewarding them at the time, they end up getting bought out eventually. And you don't see this a lot of the times for these pre-revenue companies or minimal revenue companies or pre-profit companies, because the people who are looking at these companies, they'll just wait till it goes bankrupt, buy the patents for pennies on the dollar of what you want them to.
Yeah, that's a good point.
One thing that I'd like to say is like I've heard, or I mean, I can't say that I've really followed this stock, but I mean, I've looked at it from time to time because not to put him on blast, but one of my friend's dad is a bag holder in this company going all the way back to, I believe, 2016. And, even the story back then was basically this company is on the cusp of, getting these huge contracts. Again, this is going back like almost a decade ago. And what have we seen? Realistically, nothing other than, dilution, a rollback, fundamentals that just haven't improved in any which way. And I mean, hopefully he, no longer holds the company, because I mean, really realistically looking back, from 2016, he basically be, flat or slightly down, when he could have been investing in great businesses. But like, like Brett was saying, just the dilution, they're just constantly diluting. They've got no cash flow. Not only have they been doing, private placements, they've also got their own at the market facility, which allows them to, kind of regularly issue shares as well. In the last quarter, they did a couple private placements. They were using this at the market facility. Subsequent to the end of the last quarter, they're continuing to do, private placements. So it's not a company that we would invest in, obviously. And, not one that we would say has 20x potential.
Yeah. Part of this, I was looking at some of their old YouTube videos, and the story which they were really putting out seemed to really be the same, even though I was looking at videos from 3 to 5 years ago up to even only a few months ago. It's the same story all along. But when is it happening? And it hasn't happened yet. That's and I'm not leaving my money in dead money for 10 years to hope something happens.
Yeah. And this whole story was, initially put on my radar and pitched to me as a hot stock tip while we were up at the lake on the boat the one summer, having some beers. Not the place that you should be getting your stock tips from. Anyways.
No, avoid that. Okay. Yeah. After a few beers, that's always the best time to get the best stock tips. Yeah. All right, let's move on to our final segment here. Aaron is remotely going to answer a question on Kraken Robotics, PNG on the TSX venture. It's a marine technology company. They provide complex subsea sensors, batteries, and robotic system. We have interviewed this management team, which we liked. The interview is solid a couple times in the past. We'll likely be sitting down with them once again early to mid next month and chatting with them. But Aaron's going to present on that, and then we'll have some few comments following.
Okay, my segment today is on Kraken Robotics, and we did a Your Stock, Our Take segment on Kraken about a year ago, but we just recently, over the past week, got a request from one of our viewers to do an update on the company. So happy to do that. Kraken Robotics, this is a marine technology company. They provide different types of robotic systems, sensors, and batteries for marine operations, and they primarily serve the military and defense, offshore energy, and ocean exploration markets. The company is trading under the symbol PNG on the Venture Exchange. It's trading at a stock price right now of $1.46, market cap of $336 million. So Kraken has really performed extremely well, particularly in 2024. We can see with this 5-year chart, it was really in a trading range for a while there, but it's broken out of that basically at the start of this year and has generated a substantial return for investors. When we did our segment on the company about a year ago, it was trading at 40 cents roughly. Today at $1.46. So the company's performed extremely well. Why don't we look into why? So we're going to start with the financial results, the Q2 results, which were released in August. Essentially strong performance right across the board. Revenue up 67%, gross profit up 50%. Now we do notice that gross margins were actually down about 600 basis points, but almost 80% growth in adjusted EBITDA. Adjusted EBITDA margins of 24%, up from 22%, and net income of $2.6 million for an increase year over year of 31%. Same with the year to date or 6 month results. Our revenue more than doubled. Gross profit up 71%. Again, a decline in gross profit margins, but an increase in adjusted EBITDA margins. So adjusted EBITDA up 142%. And then net income of about $4.8 million compared to marginal net income of $661,000 in the previous year. So one of the things I talked about when we covered this company a year ago was the lack of profitability. At the time, it looked like it was transitioning into profitability, but it wasn't quite there yet. And that was an issue to us, as profitability from current operations is a minimum criteria for our investment. So we can see over the past year, Kraken has made tremendous progress in terms of net income growth and just generating that meaningful level of profitability that we would need to see at a very minimum before we would consider investment. So looking at the management commentary, very positive commentary and outlook for management. They're seeing a robust demand environment with growing opportunities in the defense and the offshore energy markets. Now, this is largely driven by a global focus on security with the Ukraine war. A lot of countries are increasing their defense budgets, more focus on security. So big growth in that area, and then also energy independence and just growth in the energy sector. So the CEO said that the demand environment for their technology solutions has never been better. The opportunities they're seeing in defense and offshore energy continue to grow. Significant new orders signed in Q2, $8 million order for subsea batteries, additional orders as well. So certainly the backlog seems to be healthy. And then just in terms of management's perspective on market demand and expansion. So one of the things they're seeing, again, that growing increase on defense spending and security, one of the things specifically in expanding mine warfare market. So navies worldwide are planning and executing significant upgrades. And this is certainly something that Kraken can help to service. The company's major UUV or unmanned underwater vehicle customers are expanding their facilities. So this also supports future growth. Kraken is expanding its battery production capacity in response to increasing customer demand. The engineering business and business development are both in strong position right now, and they are continuing to invest in innovation. So they're developing their current products, and they're also investing in the next generation of subsea battery designs. And then they're also looking at a record year for service revenue as well. Now, the company has provided guidance for 2024, looking at revenue in the range of 90 to 100 million. That would be about 30 to 44% growth over 2023. Adjusted EBITDA in the range of 18 to 24 million for 28 to 70% growth, and about a 400 basis point increase in adjusted EBITDA margins. So we have seen that in the recent financial results, increasing margins on the adjusted EBITDA line. So if I were to look at this in terms of a valuation basis, and then just to essentially make a forecast on what the earnings will be for 2024, based on the adjusted EBITDA guidance, we're looking at about 4 to 5 cents in earnings per share. So say 4.5 cents. And at a current stock price of $1.46, that would be a price to earnings ratio of 32 times. So what is our take on Kraken today? Well, we like the company. I mean, in terms of just general fundamentals, they're a growth-oriented company, very unique in that they're a microcap in the defense space that is now transitioned into meaningful profitability. So they're really taking advantage of opportunities within the defense and security space, and they're doing that in a profitable way. A lot of times in the microcap space, you'll have companies that are aligned with attractive markets and industries, but they're not generating profitability. So we really like to see that strong outlook for management. They do have a net cash balance sheet as well, so strong balance sheet. Now, the only thing that I will say is that they are trading in a premium valuation of 32 times expected earnings. So, given the growth that this company is experiencing, I can't say that that's an overinflated valuation necessarily, but it's certainly not. I mean, it's not cheap at the current price, and I would say that looking forward, future growth is really going to depend more on earnings growth as opposed to valuation expansion. There's probably limited opportunity for the valuation to really move much up beyond, say, the 30 to 35 times. It's always possible, but if I'm looking at this rationally and logically, probably in that 30 to 35 times is fair value. But there are good growth drivers behind the company. So, I would say fundamentals are strong. We're continuing to look at it. It's probably time for another discussion with management, which may happen in the near term here. So trading close to fair value in the near term, but certainly very impressed with how the company has developed over the last year here. And we will be watching the Kraken story very closely.
Yeah, I think that was a very comprehensive, Aaron. It just shows exactly what we're looking for. An increase in profitability will drive the share price higher. And, last time, like you said, last time we looked at it, profitability still was a little bit maybe more on the risky side for us. But again, management's talking about demand being strong. They've got strong backlog. The Navy is making, or navies around the world are making significant investments. One thing that I would note, it's kind of a contract driven business. So, we need to continue to see this backlog and contracts continue to stay robust for continued growth in the business. But the bottom line is, right now the business does look, like Aaron said, close to fair value. But we should definitely reach out to management here. I will be doing that so we can speak with them again to get an update on the company.
And just to give an idea of how we always say, you don't always need to invest in you shouldn't invest in unprofitable companies because you don't need to be in early. So for Kraken, for example, they've returned most of the return over the last bit, 60% since June. They were already profitable at that point for a few quarters. So even if you were waiting for a few quarters of profitability at that point, you still would have had a 60% return over the past few months. And that just shows the market is not, especially for small caps, always watching. They're not going, oh, it's now profitable, we're going to put it up 500%. You have time to buy after it becomes profitable.
Yeah, it's a good summary that Aaron provided on Kraken. The real inflection in the share price started when they started guiding towards better profitability, not only this year. They reaffirmed their guidance, last year and into this year, and going forward, you can see the backlog going higher, and then, the better profitability numbers started to come in, and the stock has taken off since then. It's an excellent example of a company, again, that is driven by that underlying profitability, underlying growth in that profitability, and a forward outlook for profitability growth as well. So, that's what drives a stock ultimately over the long term. You could have sat in this stock for years while it wasn't posting anything close to what looked like sustainable long-term profitability, or at least, over a 1 to 2 year period. And the stock wouldn't have done much for you. But when it hit that inflection point, that's where you've really seen it take off. And we've seen that in a number of stocks over the past 18 to 20 months, where they've really upticked. And even just in the last 6 months, we've seen several companies really hit an inflection point in terms of their profitability and the returns. You're not talking about a 10% return. You're talking about 100 to 200 to 300%, because you're seeing that, and you get recognized for that growth and the potential for continued growth in these businesses. So, because you were trading at low valuations at that time too, as well. All right. I think that'll put our show to bed for this week. Again, if you want to attend our upcoming webinars, we have one today, the 27th at 7 p.m. Pacific. But if you're watching this after that, we have one on September 5th, 7 p.m. Eastern. That would be 4 p.m. Pacific. And if you've been listening to this show for years, for a 6-month period, you're very familiar with our research. We also have on the 21st, if you're ready to commit, become a VIP client. You get that full VIP package for a year. It's a 5-hour webinar. We're going to help you build that simple 15 to 25 stock portfolio within that webinar. So that's on the 21st. That's, again, for individuals or families who are are convinced they want to use our research to help them build that independent 15 to 25 stock portfolio. So, but those live webinars are coming up on the one that you'll probably want to focus on is on the 5th. If you're listening to this, that is on the 5th at 7 p.m. Eastern, 4 p.m. Pacific.
One thing that I'll say too, well, yeah, me and Brett are probably going to say the same thing, but we will be posting, if you do end up purchasing a ticket, we will be recording it. So say you did, purchase a ticket to the 27th today, you will receive an on-demand version where you can, go into your account, watch that at your leisure whenever you want, rewatch it, So yeah, you can definitely do that. And we will put that in your account 24 hours or within 24 hours of the actual event today.
Excellent. Keep your questions coming in for Your Stock, Our Take segments, or any questions on the markets or individual stocks. If you're watching this on YouTube right now, smash that subscribe button. If you are listening to it wherever you consume your podcast, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.